Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us for an introduction to SXO options. Options are available on various underlying securities. Today, the focus will be on options with an index as their underlying asset. In Canada, SXO options, options on the S&P TSX 60 index, are available for trading on the Montreal Exchange. These index options can be used by investors to gain market exposure or to hedge their portfolio against a broad market decline. Other videos will focus on each of these strategies, but for now, let's take a look at the specifications of this contract. SXO options have many of the same trading parameters as equity options. Call and put options are available for trading, and contracts with different strike prices and expiration months are offered for each option type. The investor's selection will obviously depend on their objectives. Also, SXO options will be influenced by the same pricing variables as other options: the price of the underlying security, the strike price of the option, the time remaining until expiration, the volatility of the underlying, and the risk-free rate of interest will all impact the options premium. Although equity and index options share similarities, a few important differences exist between them as well. The first important difference between SXO options and equity options is the contract multiplier. In the case of the equity options, the multiplier is 100 shares. However, SXO options use 10 Canadian dollars per index point as a multiplier. The exercise style of the SXO options also differ. Equity options carry an American style exercise, which provides the option holder the right to exercise at any time prior to expiration. SXO options, on the other hand, have a European style exercise, giving the holder the right to exercise only on the expiration day. However, note that index options can be bought or sold at any time prior to expiration to lock in a profit or cut losses. If the option is in the money at expiration, no physical shares of the index will be delivered. Instead, SXO options will be cash settled in Canadian dollars. It is important to note that the final settlement price is the official opening level of the index on the expiration day. Therefore, trading ceases on the trading day prior to the expiration day, which is the third Friday of the contract month. This is unlike equity options, which settle at the closing price on expiration day. In order to determine the premium of SXO options, one will refer to the options chain, which is identical to the ones available for equity options. In order to obtain the total cost of one contract, the premium listed will be multiplied by 10. If several contracts are purchased or sold, the amount will then be multiplied by the number of contracts to determine the total cost of the position. Here are a few examples. An investor wishes to buy one call option with a $6.75 strike price and July expiry. As a buyer, the investor will use the ask price and multiply it by 10. The investor would then pay $116 to acquire the contract. Should the investor wish to sell two call options with a $6.70 strike price and August expiry instead, the investor would use the bid price and multiply it by 10. The amount would then be multiplied by 2 to account for the two contracts. The investor would therefore receive an amount of $399 for the sale of the two contracts. The same calculation is used for put options. Note that as a buyer, an investor will always look at the ask price, and as a seller, the bid price will be selected instead. Let's now look at how we determine the value of the contract at expiration. To obtain the settlement value of an in-the-money call option on expiration, the investor would subtract the call strike price from the index value. For example, with the S&P TSX 60 at 690 at the opening of the expiration Friday and a call option strike price of 680, the investor would subtract the 680 strike price from the 690 index quote, which would result in an intrinsic value of 10 points. Note that if the option is out of the money, it will expire worthless and the investor will lose no more than the original premium paid for the option contract. The settlement value is then multiplied by the standardized point value of $10. 10 points multiplied by $10 equals a settlement value of $100 per contract. An amount of 100 Canadian dollars per contract would then be credited to the SXO call holders trading account, and the SXO call writers trading account would be debited by the same amount. As a reminder, the holder who does not close the position before expiration will not be receiving shares at expiration since the position is cash settled. To obtain the settlement value of an in-the-money SXO put option on expiration, the investor must subtract the index value from the put strike. For example, with a put strike of 680 and the S&P TSX 60 at 665, the SXO put option would have an intrinsic value of 15 points. Note that if the option is out of the money, it will expire worthless and the investor will lose no more than the original premium paid for the option contract. To determine the actual settlement value in Canadian dollars, the investor multiplies the intrinsic value of 15 points by $10 to arrive at $150. The SXO put option holder would then receive an amount of 150 Canadian dollars per contract in their trading account. On the other hand, the SXO put option writers trading account would be debited by the same amount. Again, remember that put holders who do not close their position before expiration will not be selling shares or assuming a short position at expiration, as the position is cash settled in Canadian dollars. As mentioned earlier, SXO options are just as flexible as equity options and can assist investors in reaching different objectives. Investors can invest in SXO options in order to trade a directional bias. By using these options, investors will gain the market exposure they wish while avoiding the stock picking process, which can be very costly and time-consuming. For investors who expect a bearish trend in the market, SXO options can be used as a hedging tool in order to protect the overall value of their portfolio. This strategy will allow the investor to limit their losses without incurring capital gains or transaction costs from the sale of the assets. In order to get familiar with those strategies, I invite you to view the SXO strategy-focused videos. Thank you for joining us.